Given it's the anniversary of Black Monday, I thought it would be appropriate to talk about my bearish thesis on the stock market. So, there are multiple factors that should contribute to a broader stock market decline over the coming months. In this video, I will talk through those factors. So, the first being interest rates. So, obviously, as interest rates rise, the risk premium for assets increase, and really just it gets less logical and it gets harder to own stocks. So, very historical, relationship with higher interest rates equals lower stock prices. That's just textbook financial markets. And I think this is really being shown in the, you can see this descending trend line of interest rates from the 90s, or I'd say the late 80s. So we started this trend line on Black Monday, and then we also hit that in the mid 90s. The stock market moved lower. We hit this trend line once again for the Great Recession. Obviously, led to a massive decline in stocks. And the scariest part about this is we just hit this trend line. We also crossed above it, which leads me to believe that we could see a massive jump in interest rates over the coming years, which would obviously be pretty bad for the stock market. And when we talk about interest rates, it always makes sense to consider what the inflation rate is, right? Because interest rates only go up in reaction to rising inflation, right? That's just the Fed's job to keep prices stable. And unfortunately, I was very encouraged. First off, I was very encouraged by the drops we've been seeing in inflation over the past year or so. So we've dropped significantly from that 9% high we saw in June of 2022. But unfortunately, and we saw that 3% CPI in June of 2023. But unfortunately, we started to rebound here. So June was kind of the lows at 3%, and now we've seen a rebound for 3 straight months. So a rebound in inflation really is going to make the Fed continue to raise rates, right? Or at least keep rates where they are until we see massive pain within the economy. And in the Fed's history, they always tend to overdo it, right? They always tend to keep rates too high for too long. They always tend to keep rates too low for too long, like we saw in 2020. So unfortunately, it seems as if this trend will likely continue for inflation, and the Fed will likely have to continue to raise rates to fight inflation. And then if we take a look at the energy prices, we can see here that energy prices have risen drastically over the past couple months. In fact, from the May lows, we're actually up over 35% for energy prices. So that signals that inflation is acting quite sticky. So anytime you get a jump in energy prices, it always signals that inflation is going to be sticky because energy touches everything, right? Energy touches every single product that's made, right? So every product, the shirt that's on your back, it's all shipped in, it's all flown in from other countries. Even if it's made in the US, someone still has to deliver it to you or deliver it to the store that you bought it from. So what do they use to transport everything? Energy, right? So energy touches every single product, and a jump in energy really causes inflation to rise for every single product known to man. Therefore, this increase in oil prices is just going to continue to, kind of pour fuel on the inflation fire. So the jump in oil prices is likely to force inflation higher and kind of keep it at elevated levels, which will force the Fed's hand to raise interest rates, which will hurt stocks. So if you kind of follow my logic there, it's all really intertwined, and it's not just energy costs that are rising. Healthcare costs have risen drastically over the past couple years. And I'll show you this chart here. So energy costs right now for an average family is about $24,000 a year. So the average employer-sponsored health care insurance premium for U.S. families rose 7% to almost $24,000 this year. So we can see that chart here, and this is up drastically from 2010 when the average cost was roughly 9,000, or excuse me, it was roughly 10,000. I should say 13 to be exact. So we've almost seen a doubling in insurance costs in the past 10 years, right? So that's drastic. And we saw a big jump in the past year as well. And month over month insurance costs are rising as well, which analysts believe will unfortunately bleed into CPI and cause CPI to jump. So over the past couple months, we've seen healthcare costs drop, which has helped CPI for sure. The health insurance index has been subtracting about 3 basis points a month from the core CPI. In October, that will change. It will add over 1 basis point to monthly CPI. Obviously, 1 basis point isn't huge, but when you're doing anything you can to fight inflation and healthcare costs are not helping you like they used to, well, that's going to make it even harder to keep inflation down. So, unfortunately, it does seem as if healthcare costs and the rise in energy prices are going to continue to keep inflation high, which will force the Fed's hand to raise rates. And it's also worth noting that interest rates are already high as it is. So further rate hikes are only going to really, really damper the economy even more. So we haven't seen interest rates this high since 2007, and we're making a new high, a new high today in terms of the short term. We haven't seen this level since 2007, so we haven't seen this level as high this entire year. So if you think interest rates are high or have been high for the past couple months, buckle up, because they're actually just got to their highest point in recent memory today, and that's likely to continue. So we can see that interest rates were at about 5% in 2006, 2007. And what happened? We obviously had, a major crisis in the preceding years. So, in my opinion, we're likely leading ourselves into a crisis once again. What sector does it happen in first? What kind of buckles first? Could be real estate once again. It could not be. No one truly knows, right? But all I know is that interest rates rising hurts economic activity, right? And as economic activity drops, you're going to see earnings drop. You're going to see stock prices drop. And you're just going to see pain throughout, average working, hardworking people. And then if things couldn't even get any worse, we have another headwind. It's global tensions, right? It's geopolitical events. It's wars, right? So in wartime, stocks typically do poorly, as you would probably assume. So the 1 day reaction to a war is almost always negative. So the average reaction is about minus 1.2% in reaction to a new WAR. I should probably say WAR because YouTube will fight channels that talk about WAR. So I'm just going to say WAR from now on. But total drawdown was on average about 5% in reaction to a global conflict. So unfortunately, it does seem as if a global conflict will likely, we see what's going on in Israel, right? We see what's still rolling on in Ukraine. People have forgotten about Ukraine, but that's still happening. That hasn't stopped. So there are two major wars going on right now. You could say the Ukraine-Russia conflict is a bit more serious, but what's going on in Israel isn't nothing to sneeze at either. That's going to negatively affect markets. That's going to happen. So unfortunately, this is another headwind for the stock market. And what is the United States government doing in reaction to this increase that we've seen in inflation? Well, they're spending less. So the US government fiscal expenditure is actually at 10-year lows. So why are they doing that? They're spending less because inflation's too high. And what's that going to do? All that's going to do is take money out of the economy, right? So there won't be that new bridge put up, and people can get hired for that. There'll be local companies that go in and do that for the government, right? That won't happen anymore. There's not going to be new roads being put down, right? Because the government's not spending. So that just takes money out of the economy. It takes money out of workers' hands, and really just dampens economic activity. So once again, this is kind of like I don't want to call it a rate hike, but it pretty much accomplishes the same thing, right? It draws down economic activity, and we're at 10-year lows for fiscal expenditures, and we saw a massive decline in the past month. So we saw almost about a $200 billion drop in expenditures from August to September. Massive drop. Could continue, right? So on the fiscal side, spending is drawing down. On the monetary side, economic contraction is almost certain, with interest rates being held very high. Obviously, we just saw Powell give some hawkish comments as well. So you add it all up, it does seem as if economic activity is almost certainly going to be constricted, which will force markets lower. So I don't, like, I'm not rooting for the markets to go lower. I'm not rooting for a recession. I'm not that type of guy. It's just, unfortunately, every single thing is pointing to that, right? So it's just basically, I'm just acknowledging reality more than I am kind of rooting for any downturn, any people to lose their jobs, anything like that. That's not what I'm doing here. And then one news event you should be aware of is we have Biden delivering a speech later tonight, actually, on the conflict in Israel, which could have massive effects on the market. He may, pledge more support for Israel, which, could bring the U.S. in, and then maybe Iran jumps in, and, then we have World War III, right? And no one wants that. Hopefully that doesn't happen. Only God knows. Really, no one knows truly. But at the very least, you could say a global massive conflict has never been more likely. We saw Jamie Dimon come out and say there was like a 50% chance that we could have a global war, which is pretty high, especially for a guy that is somewhat bullish, right? He has businesses in the U.S. His incentive isn't to say that. So the fact that Ray Dalio is coming out and saying that there's a 50% chance that we could have a global conflict is concerning as well. So he's seeing it. I'm seeing it. Kind of to summarize, interest rates rising, energy prices rising in tandem with healthcare costs will unfortunately cause the Fed to keep rates high and dampen economic activity. The U.S. fiscal expenditures have dropped off a cliff, which will also dampen economic activity, and interest rates are likely posed to move higher, and risk as kind of a cherry on top of kind of the worst case scenario for the stock market. So there you have it. I'm not cheering for this at all. I hope I'm wrong. But unfortunately, based on history, it doesn't seem that I am. So with that being said, I hope you enjoyed this video. I will end it there.
Looking to learn more about the financial markets? Well, I just released a new course that will teach you everything you need to know about the stock market. You can find that at happyinvestingtoday.com. Also on the site, you can purchase one-on-one coaching sessions where I will break down your portfolio, and to better assist traders when searching for setups, I'm selling trading bots, which will tell you how your trading strategy has performed historically on a stock, crypto, or currency that you are researching. If you would also like to see what me and my experienced trading team are doing on a day-to-day basis, join our Discord, which is linked below, for a free 7-day trial. With that being said, please leave a like and subscribe. Appreciate you watching this video.